The jobs report came out this morning. The economy lost 92,000 jobs in February. The market expected a gain of 59,000. That's a miss of 151,000 jobs. So why are mortgage rates going up instead of down? Stay with me. I'm going to explain exactly what is happening and why the story underneath the headline is actually more interesting than the headline itself. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Welcome to the Weekend Update. I'm recording this on Friday, March 6, 2026. Let's get into it. February's non-farm payroll report was one of the weakest we have seen in a long time. The economy shed 92,000 jobs against a forecast of plus 59,000. That is the biggest miss in over a year. But the headline number is only part of the story. Leisure and hospitality lost 27,000 jobs. Construction shed jobs. Healthcare, which has been carrying the job growth for the past year, also shed jobs, partly due to strikes, but the trend is worth watching. December and January were both revised lower by a combined 69,000 jobs. December was originally reported at positive 50,000. It has now been revised to a negative 17,000. The unemployment rate ticked up from 4.3% to 4.4%. That may sound small, but the actual reading came in at 4.44%, just a hair from rounding up to 4.5%. The next report will not need much movement to push that number higher. Now, here's something your clients will not hear on the evening news. The 3-month average of job creation is now just 6,000 jobs per month. The 6-month average is actually negative. The 12-month average is only 13,000. Those are not recessionary words. Those are recessionary numbers. The official government numbers are one data point, but there are private sources that paint an even clearer picture of where the labor market actually stands. Revelio Labs, an alternative employment data provider, reported a February decline of 17,000 jobs, with the biggest losses in retail trade and leisure and hospitality. Their data also suggested that January's initial strong print of 130,000 jobs was likely overstated. Their January figure was 103,000 lower than what the BLS reported. Paychex, which tracks small businesses with fewer than 50 employees, reported their small business jobs index hit a cycle low in February at 98.77. That reading represents a 1.23% year-over-year decline. It was the 10th consecutive annual contraction. Every major industry in the Paychex report came in below the 100 break-even level, every single one. The Challenger Job Cut report added more texture. The first 2 months of 2026 are running significantly higher in aggregate layoff announcements compared to prior years, and Challenger's own guidance flagged that the end of the first quarter may bring more cuts as companies tighten their belts amid uncertainty and rising costs. One more data point worth noting for your technology and financial planning clients. AI-related job cuts are growing. So far in 2026, AI has been cited in over 12,000 job cut announcements, about 8% of the total. That is up from 5% for all of last year. It is still a small slice, but the direction of travel is clear. Here's where it gets interesting, and this is the kind of thing that rarely makes it into a client conversation, but absolutely should. While the jobs picture is weakening, the underlying inflation picture from wages is actually cooling. The Bureau of Labor Statistics updated its non-farm unit labor costs, and the data showed a 3-quarter annualized decline, the first in 5 years and the largest since 2019. Year-over-year labor cost inflation came in at just 1.26% in the back half of last year. That is below the long-run average going back to 1995. In plain language, the cost of labor is not driving inflation right now. That matters because it is one of the most persistent sources of price pressure in a service-based economy. So, we have a softening labor market, declining wage inflation, and a jobs report that badly missed expectations. In a normal week, that combination would have rates moving lower. The bond market actually did move lower for about 15 minutes after the report came out this morning. Then, oil took over. Oil prices surged sharply this week following attacks on ships in the Persian Gulf and the Strait of Hormuz. Roughly 140 ships are reported to be in the area with limited ability to move. West Texas Intermediate crude moved roughly $10 higher from where it started the month. Gas prices jumped from $2.99 per gallon last Friday to $3.30 nationally today. If oil holds at these levels, analysts project gas prices above $3.50 per gallon. The bond market initially responded correctly after the jobs report. Yields dropped and mortgage-backed security prices popped. Within minutes, that move reversed. Oil prices pushed inflation concerns back to the front of the line. The 10-year Treasury is currently sitting at 4.14% as we record this. Last week's update, it was at 3.97%. That is a move of 17 basis points in 1 week, driven almost entirely by oil, not by economic fundamentals. Here's the important context, though. According to Oxford Economics, the U.S. economy is actually far less vulnerable to oil price shocks than it used to be. Energy consumption per unit of GDP has been declining for decades as the economy has shifted more towards services. The share of consumer spending going toward energy is near an all-time low. That does not mean oil has no impact. It clearly does this week. But it does mean the market may be overreacting and that the move in rates could correct when the situation stabilizes. The underlying data, weak jobs, cooling labor costs, softening small business employment, all points toward lower rates when oil steps aside. Next week is a heavy data week, and every one of these reports has the potential to move the market. Tuesday brings February existing home sales. The forecast is 3.9 million units, roughly flat with January. Wednesday's the headliner, February CPI. Headline inflation is expected at 2.5% year over year. Core CPI is also expected at 2.5%. With oil prices spiking this week, the market will be reading this report very carefully. Thursday brings housing starts and building permits for January, along with weekly jobless claims. The prior week held at 213,000. Friday closes the week with Q4 GDP final, January PCE and the Fed's preferred, which is the Fed's preferred inflation measure, and the January JOLTS job opening report. Wednesday CPI is the one to watch most closely. If core inflation holds or prints softer than expected, that could be the catalyst that shifts the rate conversation back in a favorable direction. Before I close, I want to share a few resources available for you and your clients this week. You'll find these on the right side of your dashboard or below the video, depending on your device. This week's featured articles include Countering Counterfeit Currency, Protecting What's Real, a timely piece on identifying what is real in today's financial environment. Yours, Mine, and Ours, Estate Strategies for Second Marriages, an important topic that comes up more often than you might expect in real estate transactions. What the Fed's new mortgage rules mean for your family. Plain language guidance your clients will appreciate. 5 silent credit score killers destroying mortgage approvals right now. One of the most practical pieces we have shared this quarter. VA Loan Mastery, appraisals, refinancing, and protecting your benefits. Essential reading for anyone working with veterans. And Tax Loss Harvesting and Your Mortgage Strategy, a piece that connects investment planning with home financial strategy in a way most advisors have not thought through yet. We've also put together a suite of financial calculators that are complementary for our partners. This week, I want to highlight our pre-qualification calculator. By entering a client's income, their fixed monthly debts, and available down payment, the calculator returns a rough purchase limit before we provide a certified buyer pass. It is a fast way to set realistic expectations before a showing or before a client conversation goes too far down the road. If you'd like to access the full suite of calculators, just ask. So here is where we stand heading into the weekend. The labor market is softening the labor market is softening by every honest measure. Wage inflation is cooling. The jobs data this week clearly supported lower rates, but oil is driving the bus right now, and until the situation finds some resolution, we're going to see continued turbulence. The good news is that the fundamentals underneath all of this noise are actually pointing in the right direction. Strategy beats rate always. That is true in a calm market, and it is especially true in a volatile one. We appreciate you listening. Have a great weekend, and we'll speak again next week.